For people looking to buy a home, why are rising interest rates such a big deal? The Federal Reserve controls interest rates. Banks and institutions borrow that Fed money and eventually have to give it back to the Fed with interest. This is a very simple story, so I have brushed over quite a lot. Banks borrow this money and then lend it out to people who need a loan, like those starting a business or those needing a mortgage. So for banks to make money, they need to lend out that Fed money at a higher rate than what they borrowed the Fed money so they can make a profit. If the bank borrows at 4%, they usually lend that money out at 6%, thus making a 2% difference profit from their loan to you. So that's why mortgage rates are around 5 to 6%. Right now, they're at 5.7%. Before this year, mortgage rates were around 3% to 4%. Let's just say they were at 3.5%. So let's say in 2021, you decide to buy a house that costs $300,000, so you get a mortgage. You put a 20% down payment and get a 30-year fixed mortgage at 3.5%. Including all fees and taxes, you'd be paying $1,341 per month for the next 30 years. At the end of your 30-year term, you would have paid a total of $542,000 on a $300,000 home. Of course, determining appreciation, that house would be worth a lot more than $300,000. But then let's say you waited until 2022 after mortgage rates have gone up to buy a $300,000 home. You still put down a 20% and get a 30-year fixed mortgage. But this time, instead of rates of 3.5% like 2021, your rates are 5.7% now. Including all fees and taxes, you'll be paying $1,655 every month for the next 30 years. $1,341 per month in 2021 to $1,655 per month in 2022. That's a 23% increase. Intuitively, that doesn't make sense. The interest rate only went from 3.5% to 5.7%. That's only a 2.2% increase, but your monthly went up 23%. It gets worse when you add up all you'll pay, assuming you never refinance your mortgage. At the end of those 30 years, you would have put in $655,800 towards paying off that house. That's a 20.8% increase over a 2.2% in interest. In fact, if you still want to only pay $1,341 per month in 2022, you need to buy a less expensive house. In 2021, you could buy a $300,000 home for $1,341 per month. To only pay $1,341 per month in 2022, you need to find a house valued at $241,000. You would be buying a home 19.7% less than what you could afford if interest rates were only 2.2% less. The only good thing here is that you would be putting less money down if the value of the house were less. On average, home value prices rise about 3.2% per year. So in 30 years, that $300,000 home would be worth roughly $771,000. Comparing the two rates, 3.5% versus today's 5.7%, your return would be a lot different. Remember, a 3.5% interest, you'd pay a total of $542,000 during the life of your mortgage. That means if you sold your home right after you paid off your mortgage, your profit would be 42.2%. But at a 5.7% interest, you'd pay $655,000 after 30 years. Which means if you sold after paying off your mortgage, you'd profit only 17.6% after 30 years. And that's only with mortgage rates rising by only 2.2%. The rise isn't over yet, and we could eventually see 7% or 8% mortgage rates. But with people with short memories, up until November 2008, we were used to 6% mortgage rates. In fact, we had 10% mortgage rates up until late 1990. Mortgage rates will go up and it'll go down. That just means if rates go up, you'll be able to buy less of a house for more money. And the same is true when rates are down. So what are your thoughts? Are you planning to buy a home this year or next year? Comment below. And as always, take care of your money.